Good morning, everybody, and welcome back for the 6th Annual Energy Storage Summit. I'm very pleased to introduce our next panel session. So we'll be talking around different markets for co-location and whether the UK is the best market or not. So we are joined by a great number of panelists. I'll let them introduce themselves, but just wanted to remind you all that we do have a chat function where you're able to ask questions for the panelists, and as always, we'd love to get them answered, so please do drop them in the chat and we'll come to them at the end of the session. So we've got 45 minutes for the discussion, so we'll make sure to leave enough time for those questions. So without further ado, I will hand over to Chris Hewett, the CEO of Solar Energy UK, who will introduce a bit more himself in the session and then hand over to our panelists. Hi, Chris.
Hi, Lucy. Thanks, Sando. Welcome, everyone. So for those of you who don't know Solar Energy UK, the solar and energy storage industry in Britain. In the UK, we represent about 230 members now across the whole sort of value chain of solar and energy storage and flexible power assets across the UK, from utility scale all the way down to a sort of domestic market. We also have a partnership with Renewable UK, where we run a joint working group with them, the wind industry, on utility scale storage. So that's a little bit about our work. I'll introduce the panel in a moment, or I'll let them introduce themselves. It's just sort of a few words of introduction for the session. The question, and I think Lucy's going to put up a poll now around the question we've got there: is the UK the best market for co-location of solar and storage? There's a few options for you, so perhaps whilst I speak and we're introducing the panel, we can you can vote on that, and we'll hopefully get a sense of where your views are. For us, I think one of the main reasons that the UK is a very strong market for co-location is the fact that we now have quite a high penetration of renewables, which is only going to grow. So 2020, there was 25% of all UK power came from wind and solar, obviously other sort of biomass and other renewables as well. But in terms of variable renewables, that's how much there is, and it's only going to grow. We expect there to be 40 gigawatts of solar in the UK by 2030. I know the offshore wind target is the same sort of number of 40 gigawatts, and then onshore wind as well. So it's really is a growing amount of flexibility on the system. And that's being responded, BEIS and National Grid and DNO, and the DNOs are all responding to that by introducing more flexibility into the way they're running the networks, more ancillary markets, more opportunities for sort of demand side management as well. So that's all starting to come on stream at the same time as the renewables. The solar pipeline in the UK is now extremely big. There's 13 gigawatts of projects in the pipeline in various different stages. 3 gigawatts of that has grid in place and has the planning permission in place. It's a similar number for energy storage as well, whether that's co-located or whether it's standalone. So again, there's a real sort of weight of investment ready to come into the market on this now. So the other couple of other factors is the fact that digital technology is also really becoming a very important factor in the industry now. So we're looking at more flexible demand, more use of AI, more ability to smart charge EVs, to decarbonisation of heat, and use of heat pumps and electrification, time of use tariffs, virtual power plants. All of these things are starting to come into the market, and I think that all plays into the fact that storage will play an increasing role. So for us, it's the energy industry and the technology industries, if you like, are really probably ahead of the game in terms of policymakers and regulators about how quickly we can make this happen. So the question for us is how fast can we make the deployment happen, and what do we need to get in place to make sure that private investment particularly flows? And that's why the makeup of the panel we've got for you now. So perhaps I'll before we get into the questions, I'll just ask each of the panelists in turn just to introduce themselves. And by the end of that, hopefully Lucy will be able to give us the results of that poll to kick us off. So first of all, Aazzum, Yassir. You're on mute, Aazzum.
Thanks, Chris. Aazzum Yassir here, responsible for our renewables portfolios in the EMEA region for Honeywell. So Honeywell has been actively involved in the renewable space for over a decade now. In the last, I'd say, couple of years, we've had a much larger emphasis on the distributed energy sector, and specifically around battery energy storage systems. So that's kind of where we come into. So we are delivering solutions right now with lithium-ion battery technology. but in parallel to this, we're, to kind of show how bullish we are on co-location and storage, we're actually developing our own long duration battery system solution as well, which will be available some point next year. Thanks, Chris.
Great, thank you. And Tim from Equinor.
Hi, thanks, Chris. Hi, everybody. Tim Woodcock from Equinor. The team I'm with is called Energy Storage Development. It's a business development unit that focuses on developing battery storage and green hydrogen projects as part of our larger renewable energy business, which many of you in the UK are probably familiar with, having a number of offshore wind projects operational or under development on the East Coast. So we have a pretty bullish view on the UK for battery storage, co-location, and standalone. And I think we also have a robust and bullish view on green and blue hydrogen too. And we do have one operational co-located battery storage with offshore wind project in Scotland. It's called Batwind, and I would love to speak a little bit about that today. Thanks.
Great, thank you. Next, Jing.
Yeah, my name is Jing Liu, and looking after power utilities, metals mining for SMBC in the EMEA region. SMBC is a Japanese bank with a global presence. We are very dedicated to the project financing as well as power renewable sector. This is demonstrated by the award we received last year as a Global Bank of the Year by the PFI. In terms of energy storage, we have been closely following the market. We supported multiple bidders during the enhanced frequency response process several years ago. And last year, we supported clients, helped to finance this 16 gigawatt hour lithium-ion battery factory in Sweden, which provides one of the largest in Europe, which will supply the battery to the automotives and the trucks. So looking forward to discussing with my co-panelists on energy storage today.
Great, thank you. Next, Jan.
Good morning, everybody. My name is Jan Libicek. I work as an investment director at Bluefield Partners. We're a London-based investment advisor, perhaps most prominently known for the Bluefield Solar Income Fund, which is a publicly traded investment vehicle that's currently managing about half a gigawatt or £500 million worth of solar assets in the UK. It's done fairly well, and on the basis of that, we're now planning an expansion into other markets in Europe through a new vehicle that we've been working on. So if this was a debate, because my role at Bluefield is to cover the European markets, I would probably argue that the UK is not the most attractive market for storage, even though the numbers at this point seem to suggest that it is. We're very bullish on storage. We think very likely Bluefield is going to invest in its first storage project in the UK this year, and in Europe probably in the next 2 years.
Great, thank you. And Chris.
Yeah, hi, Chris Morrison. I'm in the Green Investment Group, part of Macquarie Bank, and Green Investment Group globally has 22 gigawatts of assets in development now in renewable energy, primarily offshore and onshore wind, solar, energy from waste. We're starting to ramp up our development of storage assets to complement the renewables portfolios that we have. We're active in North America, Australia, New Zealand, APAC region, and now a growing presence in the UK and Europe.
Great, thank you. So please say the results of the poll are in, and the audience does think the UK is the best co-location site for co-location. So Jan, I don't know where you would have voted, but according to the numbers we've got here, so 36% of this audience think the UK is the best market for co-location, 23 Spain, 14 the Middle East, and then 9 each for Ireland, Portugal, and Italy. So straw poll, but glad to see the UK's on top. So Tim, I wanted to turn to you first. Yeah, you mentioned the Batwind project, and again, the interaction really between wind and solar and storage is, I think, is going to be really important in the UK. Perhaps if you want to say a little bit about that first.
Yeah, sure. So, before I begin, I would say that you can probably tell from my accent, I'm from the USA, and I would say it's subjective, not subjective, that the US is the best co-location market for a number of reasons, and we can dig into that later. But I think in the UK, there's some distinct benefits and some barriers to a big co-locational sort of opening up the floodgates, if you will. And Batwind it was a way that we were able to learn about those and identify those. And Batwind, I guess I'll just walk through very briefly. Construction began in 2017. It's a 1 megawatt facility, 1.3 megawatt hours. It was designed to be an R&D pilot system for ourselves so that we could get acquainted with battery storage in a hybrid context within a market. I guess I should remind everybody, we operate dozens of offshore oil and gas rigs in the North Sea and abroad. And those rigs are all microgrids with multiple different generating and stabilizing techs, including lithium ion and other chemical batteries, electrochemical batteries on them. So we do have quite sophisticated experience with operating microgrids without a market. But here in a market, we wanted to learn some of the things that we believe will feature very heavily in the UK on the other side of 2025 and perhaps on the other side of 2030. Ramp rate control, firm renewable capabilities. So we have high deliverability, higher effective load carrying capability in a demonstrable format for the national grid. And then, of course, we wanted to synthesize it. We couldn't really test in a true market format because of the nature of our coupling with the floating wind project, Hywind Scotland. We were not able to actually participate in frequency regulation markets nor capacity markets or even directly in energy arbitrage. We could do so as sort of a component of the Hywind Scotland project. But those markets, could be made available to coupled renewables with storage, and they are in the US and they are in other markets. And I expect that if the UK really wants to see a sort of explosion of firm renewables, which have been made so by way of storage in a storage coupled format, that the market signals and the market design really should sort of behoove it. Otherwise, it couldn't really compete against standalone storage. But there's a fair argument for why standalone plus standalone renewables could do it on its own. But I think firm resources are sort of the backbone of most integrated resource planning processes, and everything else is kind of at the margin coming into the system. So I'll stop there. And Chris, if you, however you'd like to run it from here.
Well, I think Aazzum, do you want to come in on this point as well?
Yeah, thanks, Chris. So, I'm going to try and give my answers based on the more technology kind of approach. I believe the panelists here can really cover the debt, the financing, the development side of things. So, I think if we take a step back, we're really moving away, especially in the UK and a number of other countries. We're really moving away from a grid which didn't really have any real flexibility on its network, to a grid which now demands more flexibility. And the kind of question the fundamental question we really need to ask is, will the future grid actually operate without energy storage? And, it's pretty apparent right now that it's likely not going to happen, especially with the renewable penetration figures that you were talking about. You mentioned 40 gigawatts of wind by 2030 in Spain, Portugal, Germany, Italy. There's similar figures there. We're seeing a lot of activity in Israel now, where co-location is becoming more and more apparent. And so they're really getting to the point where they want to start decommissioning a lot of the synchronous machines on the network, which means something is going to have to fill that backfill. You can't just rely on variable energy sources. You need to have some form of storage to really provide that inertia, constraint management piece. And also, in the next couple of years, you're more than likely going to see black start contracts from renewable energy sources. The only way to really provide that through wind and solar is by having some form of energy storage. Yeah. So that's my kind of take on why I believe it's a very strong market in the next 10 to 20 years.
Yeah, I want to move on to those flexibility markets. Just one point to make is Lucy's pointed out that there is a specific US energy market sort of event which Solar Media run. So that's one reason why it wasn't in the poll, but also you should look out for that one too. So I want to move on to this the whole sort of flexibility market sort of area. Chris, I wonder what your view is in terms of the opportunities that are starting to come up in terms of all those different ancillary markets and what that how that impacts on your decisions.
Yeah, thanks very much. Just to be clear, so I'm focused on standalone and co-location storage, as many of the panelists are, and we see sort of significant opportunities for both. I think that co-location assets battery assets have a very similar business model to the standalone assets, in my view. And in terms of the growth and flexibility markets, I think the UK has been at the forefront of that, certainly within Europe. And we obviously saw from a few years ago the EFR contracts come out, and we've now moved into not only as a month ahead frequency regulation contracts, but as a day ahead dynamic containment contracts, and that's been a very quite a lucrative market, to be honest, for existing battery providers at the moment, and there's a lot of battery storage in the dynamic containment market and room for more. The frequency regulation markets in any country are always going to be limited. In the UK, I think we're talking about a gigawatt or so of storage, and the market will be saturated, and that's slowly increasing as we have increased renewables penetration, but there is a cap to it. Certainly the very deep market and the market that we're seeing from an investment perspective, when we're looking at a sort of 20 to 25 year time horizon for these projects, that market is fundamentally based in the wholesale markets and the short term day ahead markets. And part of the reason for that is that market obviously just has a lot more depth, and the important aspect of that, I'm sure we'll come on to, is how does one get comfortable with that merchant volatility? Happy to talk about that in subsequent questions, but so I think that the UK market is strong in terms of those flexibility contracts that are appearing. I think we're starting to see some of that elsewhere in Europe, and certainly me and my team are very focused on Europe as an expansion beyond the UK. The UK is the most mature market. We've already seen in Italy there was a recent auction for frequency regulation that was to be honest, pretty competitive and low priced, which is a good sign given that there's a lot of activity there, and we're starting to see interest. Spain just came out earlier in February with a 65-point action plan to encourage storage. So we'll start to see a growth in flexibility markets in other European countries as well. The UK, I think, is already there and has most of the markets in place already that we need. I think we're starting to see some auctions for, as mentioned, for things like reactive power, inertia, other stability services. I think we really need to see much clearer markets for those that are easier to participate in than the pathfinders and long-term contracts that we've seen so far.
Are there any particular? So one of the reasons, I think one of the topics that comes up in our working groups on this is the emphasis on needing to decarbonize those flexibility markets. So there are a lot of flexibility markets, and quite a lot of those markets are taken up with gas peakers or diesel gensets, or turning a CCG up and down, CCGT or coal-fired power station up and down, which is maybe creating room for renewables, but obviously is using fossil fuels to do it. Are there sort of policy changes or grid code changes which you'd like to see, which if you like will enable that zero carbon flexibility to come into the market faster?
We're seeing a little bit of. I think we're seeing a slow progression towards that anyway, and the opening up of the frequency regulation markets, which is dominated by batteries now, and that's a big shift over the last 2 or 3 years from where it was dominated by CCGTs. I think, as I said, in terms of some of those flex markets and the sort of grid services markets, if we had clearer market signals rather than some sort of mandatory service agreements that we have for National Grid, and also, to be honest, as we start to see battery operators being able to service the needs that National Grid has in a more effective way, and you'll start to see that with bigger battery portfolios and more active integration with the balancing market, for example, that we're starting to see. I think that market is happening, and I'm not sure that there are any sort of distinct elements that are not already in progress or being sort of pushed forward. One thing I would flag is that Ofgem is talking about charging to NUOS to distributed generators, and that will include battery storage. This has a perverse effect that the areas where it's, when you talk about location, it's not only sort of co-locating assets behind the meter with renewable assets, it's actually co-locating them, where the generation and demand is. And obviously there's a lot of generation going into Scottish grids. There's a lot of, the vast amount of payments and balancing is for constraints on the Scottish border. And at the moment, if you apply to NUOS, to battery storage, that will prevent investment from happening in Scotland, which is the opposite of what we need. So I think a sort of clear signal we'd like to make is for Ofgem not to push to NUOS costs down into distributed assets in Scotland, and possibly no to NUOS at all for storage. And that will encourage investment where it's most needed.
Okay, that's helpful. I think, Aazzum, did you want to come in on this? I'll come to the financiers shortly.
Yeah, thanks, Chris. I think Chris made a great point on curtailments. Curtailment is hurting our path towards net zero, if you really think about it that way. And in the UK, we have a very similar scenario like there is in Germany, where a lot of the bulk of the renewable energy is being generated in the north. Large amounts of the demand are really down the south, and so you have to transmit that energy from the north to the south. And now those lines, those transmission lines, are constrained. It was slightly alleviated with some HVDC connections a couple of years ago with Western Link. There's planned HVDC connections for Eastern Link, but still this really isn't enough to transmit all that energy, especially if we're looking at 40 gigawatts. Majority of that will be located in the north. We really need to figure out a better way of managing this, and this is where batteries can really come into their own. Having energy storage systems located to the generation sites, having production of hydrogen as an example at these sites, so you can use those energy locally, having a battery corridor between the constrained parts of the network to manage the energy flow. These are the kind of things we need, and these are the kind of incentives. I believe, especially for co-location plants, there needs to be something around curtailments, extracting that energy back. And just to touch on the point with grid code, so there are some requirements in the grid code for non-synchronous machines, but typically the way you would provide that through solar energy would basically be giving some headroom within the inverters, so basically operating the plant at a lower point. And then if something is needed, you basically ramp up power pretty quickly to provide that inertial response. With wind, there's a combination, so you can do the same thing. You operate the wind at a low point, or you can actually extract some inertia from the actual kinetic energy stored in the rotating mass. Still, this isn't really going to be enough to actually, transition towards what we really need. I think you're kind of putting together a trade-off between how you want to be operating your plant to how you would like to see if inertia needs to be provided in the grid. So again, energy storage systems can be, it's already been proven, worldwide. Many countries are using this. We're working on a project in the UK now where we're developing a market for frequency response markets for DTEC there. So it's proven now. So we need to just get on with the rollout.
I've got a question, and thanks. The questions are starting to come in now from the audience, which is great. So there's one for Chris, for you. If you can clarify if co-located storage assets can participate in flexibility markets, and maybe which of those markets they can and can't participate in.
So there's a couple of questions coming through on the chat, and I know that one of the audience has flagged the points about the configuration of assets, and I would like to just sort of flag the configuration of assets because I think it's an important part of co-location strategies, and you can configure the batteries behind the inverter, and that is more efficient from an engineering perspective. But you can also configure them effectively behind the transformer going into the grid, so you effectively have sort of AC to DC conversion. And from our perspective, it's a lot simpler to have effectively a battery storage system sat adjacent to a solar PV site, a wind site, connected into sharing the same connection into the grid, but not sharing any of the other balance of plant. That gives you a much cleaner site, enables the the battery storage asset to trade in a much more free way into the flexibility markets or the balancing markets, the wholesale markets. And so to answer that point, it slightly depends on configuration, but we're looking at sort of more on the AC connected side. So in many ways, you're looking at a model which is a bit like a standalone battery, but it shares the same connection. And in that way, you should be relatively unrestricted in the markets that you operate in compared to standalone batteries. You do have to reduce the size of the battery relative to the overall connection, because obviously there will be times when you're maximizing the export on that asset. So it's a key point is balancing the lost revenue from the restriction of when you can export your battery to the actual battery size, and that's a key consideration which needs a lot of thought. So I think that's the configuration matters, and you need to think about exactly how you're going to trade the assets. But from our perspective, in order to have the most freedom to trade the assets, we give up a little bit of efficiency by putting the batteries directly into the transformer.
Great, thank you. There's another question for you there, but I'm going to come back to that because I want to bring Jan and Jing in. I suppose the question here is all these new revenue streams, all these different flexibility markets, that we have this discussion in our working groups all the time. There's the developers of the technology are saying, look all this money you can make out of colocation. The financiers are going, yeah, not so certain, not so predictable. At what point? So from your perspective, as I'll go to Jan first and then to Jing, are those revenue streams? Are the finance community in equity and debt becoming more comfortable with those cash flows?
Thank you, Chris. I think it's firstly a question of comfort, and I'll get to that in a second. But I think the second part of the question is, does the finance community really have a choice? Can it afford to ignore storage, not to consider it as a viable asset class at this time? The answer to that is probably no, it can't. And I think there are two reasons for this. One is that storage, in my view, offers a fairly elegant way to counter the yield compression trend that we're seeing across virtually all of the renewable energy markets, certainly in Europe. And even in markets where most development is subsidy free, the huge influx of capital into these markets is simply making the yields that investors like Bluefield have traditionally been used to fall. And I think the fact that you can now add storage as an additional co-located element to your project could counter that trend. And the second reason I think is it may be a way, as somebody mentioned earlier, that for investors like Bluefield to continue to operate in merchant markets. So you look at Spain, for example, the subsidies, and I have to say finally, are on their way out. I think that needed to happen, but at the same time that creates a completely new risk for investors to deal with. The fact that you can now, to some degree, mitigate that risk with storage is a fantastic opportunity. So for these reasons, I think the financing community is ready to invest. But there, in my view, I'll just very briefly mention 5 considerations that investors, I think, are looking at when considering storage. One of them is financing, whether or not it's available. And I'm sure that Jing will cover that in a minute. For us at Bluefield, we're fairly low leveraged. So for us, that perhaps may be a consideration less significant than for other investors, but still we want to see debt availability there before we invest in a new asset class. The second level is the macro considerations and the regulatory framework. So is the market ripe for storage? Markets with high penetration of renewables, obviously, like Spain, for instance, the UK, seem to be obvious targets. Is the grid ready technologically, and is the regulation there? That also is something we'll be looking at. The third consideration is the trading and the revenue stacking. Obviously, if you invest in a storage asset, you're relying quite heavily on the trading platform provider and their intellectual property. You need to have trust in the system they developed, and there are a few fairly reputable ones, but it's still a fairly new area. And so for investors to get comfortable with one of these, I think is of critical importance. The fourth thing is the fourth consideration is technology. Obviously, for traditional renewable energy investors, this is a completely new new asset class to analyze and to run due diligence on. So we need to be sure that we understand how batteries work, how they respond to things like high intensity charging, high temperatures, how that affects their lifetime, and so on. And the last thing I would mention that is often overlooked, but I believe it is equally important, is the quality of the project and the underlying development. For example, if the planning is for battery storage, does that mean that if in 10 years you want to repower your storage component using a different technology than what's available or most efficient today? So if you're replacing lithium ion with something different in 10 years, will you need new planning permissions? So I think we also need to start looking at how developers are developing these projects. To conclude, I would say that for renewable energy developers, co-location is the most natural entry into the storage market. I agree with what Chris was saying, that they share many of the benefits. For us, I think the fact that we can sort of spread the risk across a large solar project with some storage component is an easier way to learn about the storage market. So I think that's the trend that most investors in our class are going to follow.
Jing, what's your view on the same question really? So what's from the debt side, how comfortable are our investors getting with these revenue streams?
Yeah, I think from that perspective, I do agree with Jan that financiers can't ignore the storage, but they do have their preferred types of the projects or business models they are more willing to consider. Because we do see that for projects benefiting from multiple cash flow streams, we welcome that they have alternative sources of revenues and access to different revenue streams. This is welcomed. But on the other side, the issue is that navigating through the different criteria for different revenue streams can be quite challenging for financiers when it's coming to the due diligence process. As we understand, some revenue streams can be combined by tendering services at different times, where the priority may be given to the services with higher values, but some other services may require additional power storage capacity. So I think the business case for each different revenue streams can be tested against the additional CapEx or OpEx applicable to that services, which means that the developer needs to optimize this due to potentially the contractual arrangements for different services and the regimes they are benefiting from. I think on some occasions we see that storage projects may choose to take some one regime, but decide to they can accept certain penalties for non-compliance with the condition of other revenue streams, purely from this revenue optimization perspective. But for debt financiers, one focus on one side is this cash flow certainty or revenue certainty, which is probably most important, given the debt financiers don't benefit from the upside. No matter how well the project performing, probably your repayment will remain the same, given this fixed income, the payment streams. So they want to protect their downside as well. So there will be less risk appetite compared with equity investors. So cash flow certainly would be critical. And meanwhile, the issue is also about the skill. We have seen some standalone projects, battery projects. The skill is probably not large enough in terms of the cost you need to spend on due diligence, because from debt financiers' perspective, the amount of work and due diligence, internal progress is quite similar, regardless of whether it's a 10 megawatts projects or 1 gigawatts projects. So from the resourcing optimization process perspective, people naturally may focus more on larger projects on that front. So the skill of battery projects can be quite important. But we do see some positive development in the UK market where the government is relaxing the planning legislation to allow larger sized battery project to be developed.
And does that scale, can you also get that with a portfolio of projects? So does it have to be project by project, or if a developer comes along with 5 projects, is that sort of something which also applies?
Yeah, I think that's the angle, because you either have one huge project given the government relaxing the legislation now, probably you can go to the multiple 100 megawatts project now, as we see what happened in Essex, one project with 300 megawatts got the planning permission to proceed late last year. Or the other way, as you mentioned, is that to put into a portfolio of the battery projects, so the combined or aggregated project size is much more meaningful compared with going to debt financiers with one single project. But we have to say, for portfolio projects, clearly your due diligence need to be undertaken for literally for each project. So there will be
so still
certain
transaction costs,
increased amount of work, but for some part of work may be simplified. For example, compared with going to the financiers, one project by one project is probably much easier and also easier to attract the attention and interest from data financiers when you go out with a reasonable size of portfolio of projects. I think this is not just for the battery projects, even for some solar projects we see in the market, rather than going to the lender for 10 megawatts projects, you put them together for 200, 300 megawatts, then go out to market to put into kind of a project financing by refinancing this whole portfolio of assets.
Yeah, just on this, but you mentioned cash flow. There was a question again directed at Chris from the audience around whether you think the balancing mechanism is and the wholesale trading sort of strategies, whether that's deep enough to sustain that sort of 25-year cash flow.
Yeah, I think the question is saying that the balancing mechanism is a service, not a wholesale trading strategy, which maybe semantics, but maybe a fair point. So I think that the key thing, I think, as Jing said, there are multiple revenue streams for these assets. That's the beauty of them. You know, we're talking about there's a number of flexibility revenue streams. A lot of batteries are in dynamic containment at the moment because it's very healthy. We expect that those a lot of the flexibility market services, if you have to stay in them and can't participate in the wholesale markets as well, that those prices will fall as there's more batteries on the system until they're aligned. So as the opportunity cost is very similar to the expected value in the wholesale market, and that's the advantage of things like dynamic containment being day ahead rather than long-term contracts, is that you're only having to take your asset out of the market for a single day, and you can take a forward view, and that sort of very much then depends on, I think as someone else mentioned, the quality of your route to market. Yeah, I mentioned the quality of your route to market is super important there, and the traders that are operating these assets becomes more and more important as you have multiple revenue streams. So the balancing market, I think, is deep, but it's not it's not hugely deep. It's several hundred megawatts, and the batteries can operate quite short timeframes in that, and they're very effective, and they're arguably obviously much lower carbon impact than keeping CCGTs running. So we'd hope that there's sort of more room for batteries as we head towards net zero. And as you get sort of 10 gigawatts more wind on the system, we would expect, given that the balancing market is effectively a sort of a random stochastic process that is a sort of lack of forecasting or slight changes in sun and wind, that you'll start, or trips in the system, that you'll start to see a slightly bigger demand for the BM. But it won't ever be as deep as the wholesale markets, the day ahead and intraday trading, and there's a lot of money to be made even in them. I think it's been really interesting to see in January and February, we saw the decoupling of the EU and UK markets post-Brexit, and we've seen huge volatility in pricing in the day ahead. I think we've seen £1,000 to £1,500 a megawatt hour. The BM has seen £4,000 a megawatt hour pricing. Now I know that's been caused by a sort of a unique decoupling of the interconnection between Europe and the UK post-Brexit, and we hope that will be resolved in the next year or so. But we do think that it's sort of a foretaste of what things will be like in 5 years' time, and we'll see the sort of volatility when there's far more, even with more interconnects, even there's far more renewables on the system in Europe as well. Both the UK and European countries will start to see this sort of volatility, and there'll be absolutely a deep market and a demand for storage to try and level out some of that volatility.
I just want to bring in the other speakers on this question as well. Perhaps Aazzum, I know you had some points around sort of the issue around what the technology can do to help financiers get involved with this, and then after that I'll turn to Tim for experience in the US market on this, I think.
Yeah, thanks, Chris. So, I think one of the key things to understand from Honeywell is we provide full end-to-end solutions. So all the way from the battery system all the way to the operations side on behalf of the customer. So it's the full end-to-end solution. And we actually run a program called Energy Performance Contracts. And essentially what this is looking at is we try and understand, so conceptually what we do is we look at aspects of the operational cash flow from the project, and what of those KPIs can actually harm the cash flow. And we basically put together a program which shifts some of that risk onto Honeywell. And essentially what that does is it essentially makes the projects more bankable, and it allows the investment and debt money to actually flow into the projects. Now, conceptually, that's what it is. Obviously, what this translates to into the different markets globally, because we're a global player, what that actually changed to is something we can discuss with our customers, and we can really put together a catered solution for that specific market, for that specific application which they're looking for. And I think, the other aspect that we should really be talking about is future system flexibility. I think this is a really key one. So if you see the fact that, the dynamic containment market, which came out about 5-6 months ago now, I think, this is actually still undersubscribed, and it's undersubscribed because a lot of the systems out there can't actually achieve the technical barriers to actually enter into the market. So a lot of the systems which have been installed today we're really designed to do one application pretty much, yeah. So it kind of defeats the purpose of battery storage, which is essentially a asset. So you need to be working with a partner who has that kind of foresight, who can put together solutions not just for today, but also is able to develop the software. So as the market develops, the solution develops alongside it, so that you don't end up with a stranded asset. And so there's investors out there who are missing out on 150K per megawatt per year from DC, which is probably better than the upside case of what they imagined. Yeah, so something very important to consider. Yeah, thanks.
Thanks. And Tim, obviously there is a lot of deployment in the US already. What can we learn from how the finance sector has got involved?
Yeah, there's a lot of projects online already, but there's 100 gigawatts of projects in queue, solar plus storage, and 11 gigawatts of wind plus storage in queue. There is some tax credits made available to the solar side of that. That's unique, but the wind side is creditless. I think the real reason why we see these large volumes is because of the innate and intrinsic value of storage as the perfect physical hedge. It really serves as the true mechanism to honor day-ahead market commitment vacations that occur on a regular basis from onshore wind and even solar resources, even though the latter is somewhat more reliable on a around-the-clock basis. So what we've seen is that the markets, the different independent systems over there have, they've responded to federal authority that has effectively said any coupled resource should have the ability to participate in our capacity markets and also in our services markets, just as any other resource that already lives on the grid can do. And once you do that, we can provide resource adequacy because we can have demonstrable ability to serve effective load and to match load. And we can do that in the higher radiant states, and we can also do it in the lower ones. So I think to truly unlock the potential, you need of firm renewables, co-located renewables with storage. There's definitely a lot to what Chris is saying in terms of having the battery behind its own dedicated inverter infrastructure, but sharing switchgear and transformer from the renewable resource and allowing the battery to participate in the dynamic marketplace on a standalone basis. I mean, this is par for the course in the US as well as it is in the UK. But I think the real thing is, at the end of the day, if I'm planning my grid, I want firm resources that I can depend on. I know my nuclear isn't really that competitive. Do I need to build more of that, or can I build firm resources? Do I need my coal resources to come off?
Do we need to do something about the derating factors in the capacity market then? Do we need sort of, if you like, sort of joint wind, solar, and storage capacity ratings, so derating factors in the capacity market, so that they can bid in as you say, as a firm source rather than individually? Is that what we need?
I think it's a thoughtful way to consider a capacity market construct. You have a number of different resources with different deratings, and you compose your capacity market so that winning bids are coming in from different types of deratings, so that it's not just 95% available resources, because when you have that, you have a very high clearing price. Or if it's but you want to incentivize renewables to participate in your marketplace in the long term, give them a window into more market opportunities so that they can de-risk their projects.
Okay, that's helpful. Now we are running. We're nearly at the end of our time, but I wanted to just give one last question for Jing and Jan around the balance of debt and equity investors. Sort of, what do you expect to come here? Is it always going to be sort of equity first, and it's going to take a long time before the debt really gets involved, or your views on that? Perhaps Jing, do you want to start?
Yeah, I think at this stage we still expect the equity to come in first, but that, I think, from that financial perspective, we are quite keen to support the storage projects, which have been demonstrated by some past supporting on the enhanced frequency response. But from our perspective, I think the key question remains the certainty of cash flow, which for each individual projects, I know there are some questions about what kind of the combined service you would prefer. But from that financial perspective, I think the key criteria would be like 3W questions. So what's your main revenue streams, and how much you can support based on your main revenue streams, and how it's going to interfacing with your other revenue streams. And then how long is the duration of these main revenue streams? And typically this will dictate how long your debt can be raised for. And the last question is about whom. Who is your revenue stream counterparty, and what's your credit worthiness? I think that's three key questions or criteria when debt financiers look into these projects. But if these are satisfactory, clearly there will be some more devil always in the details, like ownership structure, whether you have a separate SPV with co-location projects, or you need to put them together, and how you're going to manage the land rights, access to the grid, and some certain aspects of the asset you need to share with the co-located project, even if you have a separate ownership structure. So all these detailed factors and information will be taken into consideration by the lenders when they determine the debt fronts.
Yeah, and Jan, similar question, I guess, and also for you, whether there's a factor around portfolio effects. Obviously, Bluefield Solar is mostly solar. Looking at storage now, will we ultimately see all those equity investors having a portfolio of solar, wind, and storage? Is that kind of sort of the way it's likely to go?
I think so, and I hope so. I think that would be a natural way for investors who have traditionally been sort of sole technology focused, like Bluefield, to evolve. So I am really hoping that that's the trend the sector is heading. Clearly, Jing highlighted the fact that lenders are doing fairly thorough due diligence on these new assets. That is, I think, why we're going to see investors who are happy to invest initially on an all equity basis perhaps lead the way. Bluefield is happy to do that. We're considering projects where we would be investing on this basis with the view to perhaps refinance them later, maybe with a fairly low gearing initially, to see how it goes. I think also the fact that these projects are mostly co-located again helps sort of dilute the risk between the storage component and the component that both investors and lenders are used to. And the last thing I would highlight is, and Jing alluded to this as well, I think in addition to assessing the sort of the bankability of the typical elements that you see in a regular renewable energy project, the technology, the grid, the offtake arrangement, and so on. Here, you're adding another very important element, which is the bankability, effectively, of your trading platform provider. The very key component that brings all of the different elements in the revenue stacking, the different revenue streams together. So you really need to have a lot of faith, and I think we'll see that perhaps becomes the single most important factor for assessing bankability of storage projects. How bankable are solutions provided by the likes of Habitat, for instance, and other trading platform providers, and what's the investors and the lenders' view on the bankability of those?
We are over time, But I just wanted to, if any of the panelists have a sort of a burning point which they've been itching to get in, then say so now. If you don't, that's fine, because we've tried to shoehorn a very complex debate into a small period of time. But I think that's been really interesting. Just on that last point, Jan, I think Jan. It's I've always felt that that in terms of the renewable sector, we've sort of we've been talking to equity's been heavily involved, the banks starting to get heavily involved. And some of the policymakers are saying a variable system is going to create all this volatility. Isn't that a really terrible thing? It'll never work. Whereas my sort of sense is once we start to get the trading element of the finance sector involved in this world, that's suddenly an opportunity, and that's where storage comes in. I think that's going to really sort of unlock a lot of opportunities. So thank you all for your contributions. Thank you to the audience for your questions as well. It was really helpful. Lucy, over to you.
Great, thanks, Chris. And yeah, just to reiterate Chris's thanks to all the panelists and of course for all the questions. We do have coming up next just a bit of a breakout networking session. So I've suggested that one of the topics for discussion could be, where would you set up a co-located project and why? But that's obviously, you can talk about whatever you want related to energy storage within that session. So if anyone is interested in joining it, simply click on the button on your agenda in the portal and you'll be able to join. It's kind of like speed networking where you have 4 people in a room and you'll be able to make contacts with them. But yeah, once again, thanks for all of your insights and your questions, and we hope to see you back for some of the upcoming sessions. And we also hope to work with you guys on a live event soon.
Great.
Thanks, Chris.
Thank
Thanks,
you.
everybody.
Yeah, cheers.
Bye.
Bye.
Bye.